let's talk about why Fractal wanted to host these farm business experts on this webinar.
Yeah, thanks, Tim. I think overall, like land sales aren't slowing down. We're seeing it in our data, and Grant was saying before this, a lot of land sales are moving private. We see that in the data as well, where a little less on auctions, a lot more out there. And especially if you look at generational transition and what's happening there, and just the amount of assets that'll come out, you're gonna see asset turnover, and often they will be those pieces that are must-have land deals for you. If you think about completing a section or within your operating radius, just darn good ground that maybe you've been farming for a long time with a landlord who the next generation is ready to move. And I think this is all an environment where we see land as relatively flat. Some areas it'll decrease, and Class A ground will probably stay the same, continue to slowly increase, and margins are down. And so we're in this unique environment where those who are able to grab land right now while maintaining their financial discipline, and that is a big thing, and that's part of the reason we have these three gentlemen on the webinar, because we are not growth at all costs kind of projectors or acolytes by any means. The folks who are able to take advantage of that opportunity but maintain that discipline, they're going to be the ones that are going to be able to take the next 3 years to kind of make the next 5, which makes the next 10, which makes the next 20, at what is probably one of the biggest inflection points that agriculture has seen in the last 30 to 50 years. So I think the biggest thing is, how do you find that balance? What are the tools? How do you learn from others? And how do we learn from good, smart folks? That's not me. That's these folks. So yeah, excited to dive in.
Absolutely. And, Grant, I don't know if you can share here. You shared a little anecdote with us earlier about one of the responses when you shared this webinar of someone saying, initially they were saying, like, who could possibly acquire land in this environment? You want to share that real quick? I thought that was cool.
Yeah, and just trying to promote this event today, someone had commented or mentioned underneath that, look at commodity prices today, look at the direction of land prices. Who in the right mind would be looking to grow, add acres to the operation? And in furthering that conversation, it ended up coming out, well, that individual would actually be interested in adding ground if the right piece came up for sale, but they're not actively looking for farm ground. Which I think is why it's important to be here today, is you never know when the right piece comes up and how quickly you'll need to act. Some of these transactions or offers are standing for 24 hours. So that's where it's important to always be prepared and ready. If you know that you're in a position to act, you need to be prepared for that. And that takes some work, and that's what we're here today to discuss.
Perfect. Grant, of course, I'm just rolling right into it without introducing anyone, but you've already heard from Ben Gordon, founder and CEO of Fractal Agriculture. Grant Weezy, who you just heard from, is a lender, a farmer, and the owner of Farm 640, which is a very popular farm newsletter. Evan Shout, who I'm sure a lot of you know up in Saskatchewan, of Maverick Ag, farmer coach, all sorts of different brands. He's got a million things going on up there. Thank you for taking the time to be here, Evan. And Chris Barron of AgView Solutions, a lot of you probably know as well. So these are very, very popular names, a group of people that would be very difficult to get in the same room together. So we get to do that virtually here today. But before we dive in too far, I'm sure some of you are curious on what Purdue University found out with that same poll question when they asked 400 farmers, what is a reasonable annual growth rate expectation for your operation over the next 5 years? Across 400 farmers, 38% no plans to grow, 14% plan to exit or retire, 17% less than 5, 22% 5 to 10, and then growing 10 to 15, 5% said they would, and then 4% said 15%. Okay, now I didn't write down the exact percentages of our group here. I know it was a lot lower when they planned to retire or exit, and I think quite a bit higher in the 5 to 10% annually category. But we've got some people in here ready to grow and looking for what does that take. So maybe Chris, let's bring you into this conversation here. Looking at this data here, the 38% that have no plans to grow. What do you think? I'm going to ask the obvious question so you can give the insightful answer. What's driving the fact that they have resolved to just not grow at all?
I think they're the people that talk to Grant. I think a lot of them probably, if it was the right piece and it was the right opportunity, I think they would. But I just went and printed off our aggregated data set for where growers are at right now, with the anticipation of where commodity prices are at and that type of thing. And I think there's just not a very good sentiment right now with growers currently. And so that has an impact on how they're going to answer something like this. I think short term is impacting what they see in the future. And typically what we see is, there's going to be a couple of years where the cash flows just are negative. I mean, and, when we look at a 10-year, I was just pulling up our 10-year data set, usually in a 10-year window, we see 2 years where there's an extreme amount of growth. I mean, some of those years is 25, 30%, and in some cases more than that. We usually in that 5-year period will of 5 years out of that 10, we typically see growers in that 5 to 10%, with about 8% being about average. And then we see, a couple of years that are not as good, and you might have a couple of years of loss, maybe 2 or 3 that are sideways or a bit of a loss. I think that has a lot to do with it. And I think right now, with where commodities or prices are at, it just goes right back to the sentiment where people are thinking. But I think it's interesting with this group, when 46% said 5 to 10, I think that's super accurate. So it's an indication of who you have on here right now. It's those operations that are going to grow, because there was 0 for exiting. And I think, the Purdue group was probably a group of just average, good producers, but more of an average data set. And I think the people you have on here are probably really looking to grow and trying to figure out how they do that in the next, 5 to 10 years.
Yeah. I think a lot of the folks on here are looking at this next category, this plan to exit or retire at 14%, and thinking, okay, those are my opportunities, right? Those are my opportunities to grow. What that number's higher than I would have expected, but maybe not. What do you think about that, Chris? And what do you think is driving that number?
I think that number could even actually be a little higher. In average, when we look at our clients, one of the things that we do a lot of is helping operations collaborate and transition. So we'll do a collaborative transition where they'll maybe work with an operation that wants to phase out in the next 10 years, which is intelligent from a tax management standpoint. And so when we start looking at that, it looks to us like, the farm operations, there's about 30 to 40% that really don't have a successor either. And so while they may not retire, they may step aside and collaborate or transition over to another operation. And I think that's why I think that number is probably higher if you look at operations that are going to, consolidate with others and collaborate. But, that 14% might be some that are actually going to be done too. So it's a good question.
Tim, can I ask Chris a quick question?
Yeah, Evan.
Yeah, just on, you kind of mentioned the opportunities and the lower margin side. I guess my question would be more based on, from your experience and history, do you see that most opportunities come in these down cycles, or do you see it more in the up cycles?
Yeah, that's a great question. Usually what we see is, in the last 4 years, the working capital position for our clients has increased, and I don't have that data right in front of me, but it's increased substantially. And so a lot of our clients are sitting on a fair amount of cash, or their line of credit's pretty small compared to maybe what it is, quote unquote, on average. So I think a lot of these guys, would benefit from, if that opportunity comes, taking it when things don't look so good, because when things start looking good, guess what's going to happen to land prices? I mean, that's kind of what, at least that's been our observation over the years, over the last 25 years.
What I've seen here recently is when commodity prices go higher and landlords or landowners start to see that prices are going higher, the listings really tumble in. They think that they can grab the next high for the county, for the area. But when you're in a time of the egg cycle where revenues are down, man, you can find some bargains as well. That's when you really, I think, need to be ready, because there's always the listings happening. It's happening privately. It's listings that the realtor has that's not publicly been out there yet, just kind of a napkin listing. And you can find some deals. Sometimes landlords are waiting for that high. They don't get it, and then they're willing to really offload for financial reasons or other reasons at a time when revenues are down. But I think mostly here when we're talking about expansion, are we talking about revenue expansion? This was a question that came in. Are we talking about revenue expansion or are we talking about acre expansions? Let's just maybe clarify on that here.
Yeah, I can't speak for Purdue. I think they were probably looking at acre expansions, but Evan, this is something I wanted to make sure you got to as well, because I've heard you talk about in the past, like really understanding your goal. What is your goal for growth? Can you talk about when somebody says they want to grow, what does that conversation look like, and what's growth look like in your mind?
Well, I mean, you talk about a decade ago, the word growth was pretty much synonymous with acres. I mean, land was low priced, margins were relatively decent, guys wanted to expand, and not that that's changed a whole bunch for probably the clients that are on this webinar, but as obviously from the Purdue stats, I think the sentiment's changed a little bit to where growth doesn't have to necessarily be in acres anymore. In fact, guys, I mean, in north of the border, we're looking to diversify into other operations, and I mean, Maverick Ag was our way of diversifying out of the farm just to reduce some risk. But at the same time, I still see opportunities in land. And I mean, that's why I kind of asked Chris the question, because as down cycles come, not only do we find the opportunities come a little faster, because obviously the demographic that is planning to retire is starting to see crop prices slip. And to them, that's possibly the over the fence line of, okay, now it's time to start putting it up for sale or moving forward. But for the ones, and I mean, Danny Kleinfelter said it, I mean, opportunities come to those that are prepared. So, I mean, it's having everything in place. And that's where I see the true revenue growth is doesn't have to necessarily be acres, but I think we're going to see those opportunities come and it's going to shift back towards acres again.
Yeah, opportunity comes to those who are prepared. I think that could be an alternative title for this webinar, because I want to dive a lot deeper into that. Harrison did clarify that Purdue doesn't specify in their survey how they define growth rate in this question. But I agree with what you just said there, Evan. It makes a lot of sense. But since you threw it out there, the opportunity comes to those who are prepared. Evan, let's start with you. What does that mean to be prepared? Like, you don't know when these deals are going to come along. You don't know exactly what they're going to look like. How can you prepare for so much uncertainty?
To tell you the truth, Tim, we pretty much made our business model based on that. So for us, I've probably done debt restructures or reformations for every client we've actually taken on at Maverick, just for that reason. Was guys knew that growth was going to come. It wasn't necessarily, if, it was more when. And it was, how do we position the balance sheet in a way that we can take opportunities and turn them into realities? So for guys, whether it was pushing out some of their other debt or opening up some security or just getting the balance sheet ready so that they could sign the check the moment the landlord knocked on the door and said, would you be interested? Because for us, I mean, we go by the Warren Buffett rule of 7 days, which is if you're going to buy something, wait 7 days because you'll probably change your mind before 7 days, where landlords go by the same rule. So for us, if we can jump on a land deal right out of the gate, we find there's a way better opportunity for us to get it rather than giving the landlord, that 5-6 days where we have to talk to the banker and the accountant and have it all figured out and be ready to say yes, where the moment they sit down at the kitchen table, but whether it's myself, Christian, whoever it is in the group, we're ready to say yes. And for us, last year, that was a 25% increase in acres for us. And it literally took a 5-minute conversation to get that done. So those are what I mean by being prepared and having things ready is have, Grant will probably elaborate on some of this with some of the financing and stuff, but it's just getting everything prepared so that you don't have to think about it. The decision's made before they walk in the door.
Yeah, Evan, I have a specific example this spring where an individual had called me on a Friday afternoon and notified me that he needed to have his offer into the landlord by Sunday night. And when you think about business hours and how that works, if he didn't know where his capital position was, where his break even was on each farm, that's not going to happen. I mean, there's not enough time to put that together. And that's really what you're looking at from a financial standpoint is you have to know where your working capital or your capital levels are. So you know how much cash you can put into this thing. And you have to know your break evens or your cash flow because if you're taking financing right now at these interest rates, it's probably not going to cash flow on itself. You're going to have to subsidize from other parts of the operations unless you're putting a very large chunk of cash towards the purchase. So absolutely need to be ready, know those figures beforehand. And I would say also backup plans. You know, a lot of guys, when they're buying this ground, they know that they're going to be doing a 1031 exchange. They're going to sell that, you know, that 80 that's 20 miles away to help them bring on these 200 acres here. So sometimes it isn't always an outright purchase. It's you know, adjusting what your farm looks like to better suit you for the future or the next generation.
And I think what we found too is it, you know, a decade ago you could buy a quarter or you could buy 300 acres up here in Canada. And that was kind of the big packages. And now it's farms that are selling. So it's 3,000, it's 5,000 acres. So all of a sudden it's not, you know, 300 grand, it's 10 million. So the numbers have definitely shifted. And I think that's where some of the preparation has come in. And I mean, the other figure that a lot of our guys want to know is, you know, if I do buy X amount of acres, in order not to inflate my cost, because as you said, the interest costs alone drive up your cost of production. Guys are looking at, well, how many would I have to rent on the other side to actually keep my numbers somewhat sustained in the area I'm comfortable with? Because that's what we're facing. Because up here, I would like to say it's a sin to sell land or to get rid of land. So guys aren't really flip-flopping. They're more or less looking for that next package just to continue the growth factor.
And can you even find that land to rent? I mean, it's going to be just as hard as finding land to buy in some cases. Chris, let's bring you in here. I think you mentioned the working capital situation earlier. So the farmers you work with, are they prepared for these types of opportunities? The type where, you know, Friday afternoon, you have to let somebody know by Sunday night.
Yeah, I think a lot of the guys we work with have that balance sheet, you know, really in good shape. The working capital, like Grant brought up, is really the key though, and having yourself positioned for being able to do that. I think a lot of operations too are looking for that high quality land too, and so that's the other thing is you know, there's a certain type of land that a lot of these guys are looking for. It's not maybe the low quality, but that mid-range stuff that they can improve and work on, I think has been more attractive lately from kind of what we've seen. And the other thing I would say that we see that sometimes gets forgotten is the contribution margin to the additional acres that brings, because all of a sudden then you're spreading those fixed costs out over a lot more acres, and that has a bigger impact than people realize when you sit down and you do the math on that. And when we look at cost production change on a fairly large purchase, even last year with a client, it was actually way better than I thought it was going to be. You know, when we sat down and looked at the cash flow and looked at how they were going to be able to manage that moving forward. So I think you really got to sit down and not only be ready to do it and make that decision in 7 days, like Evan said, but I think you got to make sure that you look at all angles of the math and you know, not just the cost, but what are some of the benefits too.
Well, and I've seen that especially on the equipment utilization side, Chris, because I
Right.
mean, as we expand, if you don't have to expand the equipment line at the same time,
Yep.
it's a significant saving. So for us last year, we took on 25% growth, never had to add a machine, and our cost of production actually went down.
Correct.
So it's those, and I mean, obviously there's some nuances there, whether it's 24-hour seating or however you want to get those efficiencies. But for us, we'd rather have the land in possession and run the equipment a little harder or run the people a little harder. So it's those discussions that guys are having on the income statement side. So not only is the balance sheet bulletproofed, but the income statement side, you know, where do we rob from in order not to drive our cost of production to a place that we don't want it to go, right?
Yeah. I would
Evan,
add that.
I'm glad you brought that up. I ran some numbers here this morning, just helping to compare, you know, what it looks like to expand the equipment side of the operation versus the land side of the operation. So let's say you do need to go out and buy a new tractor, or we have a trade in and you're looking to finance $250,000. So a $250,000 note at 7% interest over 5 years, you have payments of $61,000 roughly over those 5 years. If you were to go and buy $1 million farm, make a 20% down payment, so you're financing $800,000, 7%, 30 years, that's payments of $65,000 per year. So you can almost buy $1 million farm for the same amount of payment. And we're talking cash flow here, break evens, not the capital in, but the cash flow. The land was $65,000 towards a $250,000 equipment note of $61,000. So when you're preparing to go and buy land, you have to be keeping that in mind as well when you're evaluating your equipment line and other improvements that you're looking to make with the operation.
And I think that works on both the cash and accrual side. So you're talking from the cash side, and I mean, if you look at it from the accrual side, it's the same thing as the additional land interest that'll hit your income statement compared to the amortization costs that are coming out of a brand new $1 million piece of equipment. It actually shocks guys when they actually see what the numbers switch is. The land all of a sudden looks more affordable than just looking at it from the outside in, right?
Yeah,
And one thing we've seen guys doing is, you know, putting more debt on the equipment. In other words, the interest rates, and especially I think in the next couple of years, I mean, we've seen an inflationary impact in the last 4 years on equipment of about 36.5% on new equipment in 4 years. And so what we see some guys starting to do is looking at, maybe putting the equipment in a scenario where, you're trading the equipment more often, locking in this low interest rates. John Deere's laying off a bunch of people right now. Again, in fact, they laid off engineers for the first time, I think, since the 80s, here about a week and a half ago. And so the demand right now is really off the pace. So there's going to be some really good deals and ways to reallocate that capital on the equipment and free up capital for other activities like the land purchases and those types of things, that kind of restructure in a way that allows for that growth in a difficult time. So there's a lot of different creative ways to kind of think about how you buy that that parcel, or how you maybe buy a bigger chunk than what you think you can, kind of like what you guys are doing, Evan.
Well, and I think the discussion comes down is, do you want to own a depreciable asset, aka equipment, or do you want to have a whole bunch of capital sitting there waiting to buy the next piece of land? That, I mean, in Saskatchewan, we've had 32% appreciation over the last 2 years. So I'm not saying that's going to continue, but if you bought the tractor 2 years ago versus the quarter of land, I promise you, I know what your answer would be right now. So
Yep.
for us, I honestly don't even want equity in my equipment, because right now I just want to rent it. If anything, it's just a means to an end.
And Chris brought up an excellent point there. In his scenario, they're looking to finance as much of the equipment as possible to hold onto the cash. The scenario that I had brought up was kind of the flip-flop. It was protecting the cash flow. And so that's about knowing your position. You got to know, are you strong on capital? Are you strong on cash flow? How do we attack this? What's your personal approach going to be? Because it's different for every operation. So we've kind of seen both sides here.
Yeah. Well, we talked a lot about kind of like, getting prepared so that you're healthy today for whatever opportunities come up. But what about projecting forward? Like, how are you all thinking about a 5-year plan, or how are you doing scenario planning for the various things that could pop up? I'd be curious to hear all three of your responses to that. How do we make sure that we're not only prepared today, but we're thinking about what might be coming around the corner?
I think the first thing is you have to figure out what's going to be potentially available and start having those conversations too. I mean, sometimes, it's a parcel that you never had any clue of, but on the same token, there's opportunities out there. It's having your ears to the ground and knowing what the opportunities are. And the other thing we've seen that's been very successful with a lot of our clients is back to that collaborative transition. You start transitioning over to some of these other operators, and if they are going to slow down, maybe they do want to liquidate some land to, start traveling or doing whatever they want to do. And I think having, we've seen tremendous growth opportunities come from that, because a lot of those sales are private, right? They're nobody else knows about them. And so you want to be one of those people that can be purchasing that private, doing that private activity that nobody else knows about. And how you do that is, it's not going and saying, hey, I'm interested in renting your land someday. If you're going to slow down, it's going and saying, hey, I want to learn more about your operation. I want to, see if I can help you. I'd be interested in backing you up, and start to build those relationships. And those relationships are what end up being a lot of those private sales. And people are like, I didn't even know that was for sale, so.
And for us, I find it's a bit twofold. So the first one is that, I mean, I noticed this in the coaching course that we run, was nobody ever has a 10-year plan or a 5-year plan or a 3-year plan. Nobody's ever written it down. They might, have it in the back of their head, but to actually write it down and say, what does the farm look like in 10 years? And I mean, it's the first question we ask, and it's usually the hardest question for producers to answer. So, I mean, having that growth scenario in their head, if all things worked out perfect, where do you want to be? I think that was the first, notch of getting them to start thinking about it. And then it turns obviously into a capital plan and a land plan and, what size do we want to be and everything else. And then, I mean, the second one was just having them thinking about what could happen. So like you said, having those landlord discussions ahead of time and coming up with scenarios. I mean, in Canada, obviously we have some interesting tax changes in the last, decade or so that have made land rent in companies almost oblivious because I mean, it's a 50% tax rate. So it's getting creative on not only the tax side, but also the financing side, whether it's joint ventures, having all those discussions ahead of time with landlords, because a lot of times nobody's ever asked them what they want. They've always come in and said, well, I'll give you this much for rent and we should go from there. We found that the best negotiating tactic on land was walking in and just asking, what do you want to get out of this? Like, do you want to continue to own the land for the future? Are you looking for X amount of dollars? How much can we rent? How much can we buy? Like it's them telling you, essentially giving you the cheat card, right?
I see we do have a hand raised in the audience. If you do have a question, I don't think I can pass the mic to you, but if you have a question, I encourage you to use the Q&A box at the bottom. We see all of those that come through. All the panelists will see that, and we'll make sure we get it answered there. But this is really good. And Evan, I want to actually go back to something you said earlier about growing 25% last year and how you had the people and the equipment that must have been stretched pretty thin before that time that you could just kind of jump right into it. How did you know that opportunity would come before the whole system would break down? How did you know you could push it that far and that you would that opportunity would come to you?
I think for us, we rely on data for a lot. I mean, anybody who's watched us or heard us talk, the data pretty much drives most of our decision making. So I can tell you what multiples on drills we have, how many acres per drill, how many acres per combine, how many acres per human. So, I mean, those metrics allow us to build something and put it in place before the growth happens. And anybody who knows my business partner and I, growth is coming. That's not an that's an expectation. It's not if, it's when. So we build it. And if we find good people, we hire, because right now people's probably our biggest issue on growth is making sure that we have the team in place. So for us, hire good people, because as farmers, we're really good at finding work. That doesn't ever seem to be the problem. Finding work's pretty easy. It's finding good people. So for us last year, it was, we knew we had the people in place. We knew we had the equipment, and it was going to be stretched. But in order to have access to the land and control of the land, it made sense. Now going into next year, if we see another, extra few thousand acres pop up, then it changes some of our multiples. But for now, we're sitting, and I mean, it dropped our cost of production by about $40 an acre to expand 25%. So that, I mean, it just made sense on every front.
Great. And we do have a question for the audience I'll get to in a minute, but Grant, I want to get the lender's perspective on this. I've never been a lender, but I imagine I'd be sweating a little bit, looking at the farm economy, looking at all these folks that want to grow and wondering like how is this all going to work? So from a lender's perspective, what do you think of all this, and what can the folks in attendance here do to position themselves to have a lender happy to lend to them?
Well, the nice thing, and I'm speaking a little bit regionally here, but from a Corn Belt standpoint, profits were just enormous in 2022. So not only were we able to heal a lot of balance sheets, we were able to really grow our capital positions within these operations. In 2023, we did see a step back in a lot of the working capital on those balance sheets, but frankly, I think that the farmers are well positioned to move forward here and make some improvements. There were improvements to the operation from an efficiency standpoint this past year, be it equipment, grain systems, or maybe even labor, and correcting some of those issues. But it's, we talked about it earlier. It's about knowing your position. It's knowing how we're going to utilize that cash today. What are we going to hold on for? And it's having, like Evan had mentioned, have that 5-year plan. Know what might be coming, but don't let that hold you back at the same time. Just because you your 87-year-old landlord might sell to you doesn't mean that you should not be prepared for other opportunities that come up beforehand. You've got to be ready to pull the trigger and have the partnerships established already. And that's partnerships with your lender, ag experts, but it's also neighbors, ag businesses, and even consider partnering with resources with other farmers in your area. Always be doing that networking and being prepared to take that next step within your operation.
Grant, just from like a lot of the customers that we're talking to, like I think there's always a spectrum. So there's the, Evan's crazy with his 10-year plan to I know the next deal. I think like the base minimum that we often find that provides some level of security is what's the deal after the next one? And what are the relative sizes that you can handle and knowing those limits? And it comes back to, I think, what all three of you have mentioned. Is the limit ongoing cash flows? Is it working capital? And that's tied to your whole plan because there's going to be a trade-off on one or the other. And so just knowing that as a first step is often a really, really powerful way to take advantage of those opportunities.
Yes, I mean, with interest rates, Ben, a lot of individuals will say, well, let's throw all of our cash towards this purchase. I want to borrow as little as possible. And when you think about the purchase after the purchase, then you can't make that next purchase, that second purchase. You've got to be thinking one step ahead, use some balance between finance and cash, and be ready, because I've had multiple farmers that have bought around 2 consecutive years. They didn't know about the second farm that was coming, but because we had established that we have a growth mindset, we're planning to add 1,000 acres in the next 3 to 5 years. We didn't go and burn all of that cash position, and we could pull the trigger the second time as well.
Well, I think the interesting part is we talk about 5, 6, or 7% interest like it's the most terrible interest rate we've ever heard. When I mean, we can go back a couple decades and it was 15 to 20. So I think we got to keep that in mind too, is that I know there's sticker shock with it, but at the same time, if the numbers on the balance sheet and the income statement work at these rates, there's no reason not to pull the trigger in certain scenarios. So much like you said, Grant, I hate watching guys drop cash on a parcel just to see the next parcel come up the year after, and all of a sudden they're not even in the running for it. So it's having those plans. And I mean, like I said, opportunities, especially with the demographic age of agriculture right now, they're going to come. It's just, can you be ready, and how many can you be ready for, right?
Yeah. Opportunity cost is a tough one to quantify and understand. It does get back to something that I hear, which is if somebody's willing to grow and somebody else it doesn't see the opportunity to grow, they say, well, they're just willing to take on too much risk, or they're just, they're just too risky with what they're doing out there. So I guess to try to simplify a question out of that is like, all right, how do you make sure, how do you manage risk but still achieve your growth goals? Are there things we haven't talked about yet so far that we should speak to? And Chris, I'll give you the first chance at that one because it's been a little bit since we got back to you.
Yeah, you were kind of cutting out there a little bit. Can you give me that
Oh,
question?
sorry about that. Just, I think speaking to the perception that if you're growing in this environment, you're just taking on too much risk. So how do we, anything we haven't talked about so far? I know we've been speaking to this, but about managing risk, but growing in a risk managed way.
Yeah, I still think I would echo what both Grant and Evan said though about the numbers. I mean, it's amazing how a lot of people, like let's use machinery and equipment for example. It's the second largest line item expense for producers, and it's the most misunderstood cost of production. And there are ways to sit down and calculate what that cost is and put those numbers down and figure out what your costs are per bushel, per acre, as a percent of cost, and figuring those things out and knowing when you make changes, just like Evan did when he, added those extra acres, he instantly knew what the change was, to cost production. And it's amazing, there's still a lot of us out there, and I guarantee you there's some that can think about it that are listening here that probably, if you're really honest with yourself, do you have all the numbers in place that you really should? And we can talk about it all day long. We can say, yeah, you need to do this and you need to do that, but you actually have to take action. You actually have to do it. And that's the office time. That's where the money is made, it is in that planning. It's just like, Evan said, you do a 10-year, a 3-year, and a 1-year plan, you can figure out what you need to do to get to 10 years. Because if you know 1 year gets you, 10% of the way, and you get to 3 years, that's getting you there. You need to know exactly what that metric is. And I think, to be honest, I think there's a lot of people that are fairly lax, and not picking on people, but I'm just saying that that's kind of a reality, is that, and those of us who will sit down and literally do the math and make Grant happy as a lender, so that he's on board with us, and I'm not going to get any flack from him. I think that's the key, and we can talk about it all day long, but you literally have to do it. I mean, that's just the bottom line.
And I think the stats coming out of TPAP at Texas A&M still show greater than 50% of the industry has no idea what cost of production is on their farms.
It's sad.
So, I mean, and when you don't even know the starting point, I really don't know how you analyze and say that land's overpriced or interest is too much and I wouldn't expand, because you don't even have a base. So for me, that's step one. Step two is essentially worst case scenario your farm. So what does the worst case scenario? I mean, we all know the insurance products, we all know the subsidy products. We know what that worst case on the income statement looks like, and what does that do to your balance sheet, or what does that do for the next land purchase? So understanding not only what the budget is or what the great scenario is, but also understanding that at a worst case, X is my biggest loss. Because especially in Canada, the last couple of years with commodity prices where they went, most of my farms were bulletproof. So I made the joke before we started this that is farming really risky anymore? I mean, up here for the last couple of years, we had risk-free farming, and I can actually call it risk-free farming, where maybe we're not in that same scenario right now, but we're not that far off. So, I mean, for guys that can control their cost of production, know what the worst case scenario is, land deals come relatively easy on the math cycle, because it doesn't put you in a position that, as you said, Tim, is huge risk.
That's a great point, Evan. I think of some of the producers that I've worked with. They're aggressive in their growth, but extremely conservative with their numbers. So they'll come to me with their cash flow for the upcoming year, and they're showing barely break even. And I know that they've made $250,000 to $500,000 each of the last 6 years. And it's like, what are we doing here? Like, I think you're positioned better than that. And it's that worst case scenario. They're prepared for the worst. And even in the worst case scenario, they think they can still come through break even. Now, when they have a home run, knock it out of the park here, they're ready to grow and they have that plan in place. But you do need to know what that could look like for you.
The other thing I would say too is, the crop insurance that on the US side anyway, Evan, that we have available is just outstanding, really. And you look at the new farm bill and some of the changes that are going to come there. There's going to be some really good stuff coming too, as far as protecting us. And a lot of these guys, if they have the higher quality land, if you are buying that higher quality stuff, it's easier to insure it. Your APHs are higher. You get back to that almost risk-free, and I say almost because you can have that gap, but you can really position yourself well with crop insurance, if you so choose, because the tools are there now to utilize them.
Well, and I think another thing that's changed, especially in our side of the industry, is that 5 to 10 years ago, guys didn't even look at the numbers on crop insurance. They bought it because grandpa bought it and dad bought it, and that was what you did. Now, we've got engagements where we'll sit down and go through every insurance option they have to identify, where am I protected? What's the number? Guys are understanding the insurance and the subsidy side a little better, so they know those numbers, off by heart.
Can I say one other thing too? And this kind of ties into Evan doing succession planning and stuff. We don't want to see farm operations buying the land a second time either. Have a plan, have a succession plan, figure out exactly where your operation is, where it's going, and make a plan with the entire family, because a lot of times there's multiple owners in the family, and what are their long-term plans? What's their 1, 3, and 10-year plan? And make sure everybody's on the same page with that succession, and then you don't end up necessarily having to buy the same land again, generation after generation.
Well, and I think guys, I mean, especially up here, they're getting to the point where they don't want to sell the land. I mean, the generation moving out,
Right.
there's beautiful appreciation on it. They can get a return on it from the existing farm operation. I mean, it's a retirement plan. So from our standpoint is we don't want, like you said, we don't want to have to buy the land twice. We actually want that to be a way for retirement and purpose and everything else to move on. And it just allows the farm to keep expanding in size because they don't have to put aside capital for those acres. They're looking for new acres. They're looking for new revenues.
Yeah. Well, we're going to get a chance to kind of make all this real because we have a real kind of coaching question here in the Q&A that I want to get to. So I'll read it. I'll give you guys just a minute to think on it and then give all three of you a chance to dive in. It's an anonymous attendee says, I'm a good-sized young operator with a large land base. I have working capital in excess of my annual expenses and have a very profitable crop locked in for this year as long as we grow the crop. I need to make some farm improvements of grain storage and drain tile that I plan to use some working capital towards, but have been just stashing in money market funds for now. I bought 2 quarters this year and am financing a large part of it. My growth plan in the future would be to use enough cash down payment to make the land close to cash flow, even on that piece of ground. What do you guys think of the strategy?
Cash is king. I would want to stockpile and keep as much of that cash available as possible. And, to have enough cash to cover a year's worth of expenses is a great position to be in. I can think of an individual a farmer who was sitting at a very nice cash position and just randomly had the opportunity to buy 3,000 acres privately. It was out of county. It was in a different area, but a $750,000 down payment, throw it towards it, and it was privately financed and bought this large purchase here because he had cash available. So the opportunities, when you're in a position to buy and you're known as a buyer, more opportunities come to you. And when you have that cash, I think it's just easier to pull the trigger. And I mean, frankly, he made that purchase and he's still ready for the next one because he has enough cash available.
Chris or Evan, anything to add to that?
Go ahead, Chris.
Yeah, I guess I would just echo what Grant said. I mean, if you're in that type of a capital position, you can pretty much write your ticket. So, that's where you want to be. That's where you want to get. But I still think it has a lot to do with, putting that plan together and making sure, you don't pass on something because you can get in a position where you continually build cash because you're worried about the next year and the next year. And sometimes you want to make sure you don't give up that opportunity to buy that parcel because, it is an appreciating asset. Land is a really good investment. And so, there's a balance there for sure.
I think my answer might differ a little bit just based on our banking north of the border. But so for us, loan to value, we can get, 70 to 80% loan to value on most land. So I know that's going to piss off a few people on the call, I think. But for us, I mean, debt isn't a dirty word anymore. And I mean, we always used to be scared of debt and guys wanted to be debt free. And that was kind of where they were shooting for. For us, it's all about return on investment now. So when we're looking at deals, and as Grant said, cash is king. I don't want to spend cash. In fact, if I can use equity on other land to do the down payment for new land, that's where I'm going. Because again, Chris, land is an appreciating asset and it's an investment. So for me, I don't use cash unless I truly have to, because I want cash to be aside for operations. If we're going to take on that 25% expansion, it costs a little bit more money to put the crop in than it used to. So for us, we keep the cash, utilize debt as much as we can, fix our interest rates as long as we can. I mean, interest rate swaps have come around the last few years. And I mean, if you'd done it back during our pandemic years, you'd have probably had, some very attractive 2% rates for long term. But even now, I mean, we're looking at 5% for 10 years. And I mean, that to me is not a bad rate. So you get rid of your interest rate risk. I'm okay having debt on the balance sheet as long as it's on appreciating assets. If we're talking equipment, no, I don't like loading up debt just so you have massaging seats. So
Yeah, Evan, it feels like everything that you guys have said comes back to what we led off of like what is growth, and growth is as much of a mindset as anything. So if you're in a great capital position, like the folks that we see who are able to take advantage of those big opportunities and be prepared, they're still acting and pulling the levers to improve their margin structure and ensure security so that when they have that big opportunity, they're ready for the next one, even from a position of strength. Right. It's similar. You talked Buffett earlier. It's like how he bailed out Goldman Sachs and made a ton of money on a very low risk investment. It's because he was there at that right time. You see that in the farming community today. And there is always a constraint on what you're doing. There will be a constraint and there will be a limit. How do you understand how those limits will change with the decisions, and how can you push those limits out while still maintaining the core of your operation from a risk management standpoint and frankly the values of your operation, which is one of the things that our customers tend to, it's why they're engaging with us versus a traditional just rent only expansion strategy. It's because they want to have that extra optionality.
We'll follow up on that because you said how your customers are engaging with you. I'm sure there's people on this webinar that don't know what fractal agriculture does. They're like, thank you for this webinar. This is what I needed to hear, but I don't know who this fractal agriculture is. So I want to talk about that. And for the other three of you guys, Evan, Grant, and Chris, I'm going to give you a chance for final thoughts here in just a minute, as well as kind of final action items for those in attendance. So be thinking on that. But Ben, maybe give us the quick version of who is Fractal and what clients are you working with?
Yeah, we're a farmland capital provider. We provide equity capital. We will invest in a piece of land that you own today, up to 45%. Farmer maintains control. They own the title, and they take the proceeds from that sale to go make that next deal or make that next capital investment. So from that question we had, whether it's a high ROI project like storage or grain tile or buying the next farm, we're not going to get into the farmer's business there as long as they're in a good, strong financial position. And really, it's another option to kind of move those constraints out further because you either don't have to put up as much cash upfront and we're lower cash flow during the deal. And so you use us in combination with debt as that partner to bring more total funds into the business onto your balance sheet. You keep control, and in return, we think our investors get a heck of a lot better deal because they're investing alongside farmers who we think are the best darn stewards financially and beyond for that land. And I'd be curious from the other guys. I mean, like we've all talked about this, like where you think it's a fit, and importantly, like where it's not out as well.
And just to clarify for anyone who might be hearing about it for the first time, so you basically, are you becoming kind of a silent partner in the current land to provide the capital so that they could grow and buy other assets or invest in their business in some way?
Yeah, absolutely. I mean, like it's all in the contract. We don't take agronomic control. We do incentivize, have some discounts for soil health driving practices that we just think are great agronomy, where the farmer decides those practices. But beyond that, it's essentially we're a capital provider. We're not a landlord. We're not an owner.
Okay. Yeah, and I know you asked, sorry, Chris, Grant, Evan, any comments on where a model like that might fit?
I think, and I mean, obviously Ben and I talk quite a bit, and from my perspective, it's access to capital. So for us, it's not necessarily just the banks that I'm looking at. It's private investment. It's in order to take on the amount of land that's going to trade hands in the next decade, we need companies like Fractal and other private investments in order to do this. Because like I said, the average age of a farmer, especially north of the border, is 60 to 61 this year. 80% of the land's going to change hands, whether through succession or sale. There's not enough farms that are, right of that column that says we're not going to buy anything to actually take on all the land that I think will be trading. So from that standpoint, any way of getting additional financing and access to capital, like it's one of our biggest risks on our farm, is that can we have the ability to continue growing at these rates? So that's why, obviously, like I said, I spend a lot of time with Ben, and we talk a lot of this stuff, is that land is going to be available. It's just who's ready to buy it.
Yeah, it's always that next one, right? You get something done, and then it's having access to capital on that next sale, because sometimes you don't know what you don't know. All of a sudden you buy something because it's across the road, and then another one on the backside of your farm comes up, and how do you have access to the capital and you don't want to give it up? So having these things in place ahead of time, you don't have to use them right away, but get these things in place, because that's what's going to create the opportunity for growth if you set yourself up for that. But, and that's really the key, I think.
We've seen in my area a large number of investors, both independently and large groups, come in and buy in farm ground. And they have different a different level of resources, and I'm going to say tens and hundreds of millions of dollars of cash that the local farmer just can't compete with. And so when we talk about having a plan A, a plan B, a plan C, you need to start thinking maybe a little bit differently in order to compete with some of these outside resources, and having a lot of different plans in place, whether it's partnerships with different farmers, or a partnership like a Fractal, who is there to keep the ownership local and in your name.
Cool. And we do have a question on Fractal here. As I asked this question, we also have a poll. If you're at all interested, if you have questions about Fractal or want to learn more about how they might be a fit for you, just answer the poll question there and somebody can reach out. You do have the option to not. So that's okay too. We're here to provide value either way. But Ben, question for you from the audience. Is there a risk that Fractal Ag says, I want a return on my equity, and you have to buy them out on that piece? I'm wondering, and this is me reading here, I'm wondering why I jump in with Fractal versus financing if I can make it work.
Yeah, I mean, it's a classic investor question, right? So I think the first one is we lock the investor up for 10 years. So you have that complete security. You know where this fits in your capital stack, like contractually obligated for 10 years. And then the next answer to that question is really, it depends. But it all depends based off of everything that these guys have been talking about. Like, what is your cash position? What are your cash flows? And if you compare financing to us, like, we expect you to use debt. We're not trying to compete with the bank. Why you would use someone like Fractal is if you want to push those constraints out while still being disciplined, you're going to be able to go further and faster, especially at a time where growth in both acres and other investments that you're making is so powerful in your business. And so if you're going to lever up to a spot where you can't do the next deal, well, financing might make more sense on one deal, but if you do two or you do three, Fractal plus financing and the operational benefits that both Chris and Evan talked about to your business, we're gonna beat that one deal with financing every time. And generally your banker likes it too, because guess what? He just got to do 2 or 3 loans versus one. And it's kind of part of the whole idea of so Evan, we don't have your 70 to 80% bankers, but down here in the States, like good disciplined debt providers and good disciplined operators, like there's a tremendous opportunity out there, and we're just trying to ride that wave a little bit. You really got to push in when we're talking to a farmer, like we go through literally the deal model I show investors to say, in these appreciation scenarios, here's the cost. You buy us out early, here's the cost. It needs to be super transparent to everybody in that, because if it doesn't work for you, I don't want to do a deal, because that's going to be crappy for our brand.
Well, I know Evan and Chris are both podcasters, as am I. We usually would have these conversations one-on-one for a full hour and still go over time. So the fact that we're close to on time with all of us in the same room is pretty impressive, I think. I do want to give everyone a chance for one final comment, though. Might run us over time just a few minutes, but I think it's definitely worth doing. Just anything you'd like to add or emphasize from the panel before we close out. And Evan, we'll start with you.
Yeah, I think obviously from the talk today, I'm still an optimist when it comes to agriculture, and especially on land. I mean, give me a loan and I'll buy it myself right now, because that's the mentality up here, is that land appreciation is still moving. We're still behind other areas. Obviously, it has to work for the balance sheet and everything else, but that's why clients come to work with us. Is I want to work with the producers that are progressive. I don't want to work with the complacency, because to me, complacency is not, it's not exciting. It's not interesting. For me, it's that next level. So, and like I said, I'm a huge optimist. So I think it's going to be just fast paced and adapt in the next few years.
And Chris?
Yeah, I guess my thing is what I already mentioned is just making sure that you've got your numbers rounded up, and not just kind of halfway doing it, or get things accurate, and know that cost production. Make sure that the insurance and your risk mitigation plan is in place from one year to the next. Watch that working capital, and then make sure that at the end of the year, one of the things that I always encourage our clients to do, and we've got some of them doing it, but we like to do a state of the business address at the end of the year, where we put all of our financials on a PowerPoint presentation, and we give the presentation to all of our lenders, our partners, our family members. Everybody hears the same thing, and whoever's running the operation, and I always call it Hell Week, basically, where I'm going and putting all of our math and all of our plans and all of our strategies in one presentation at the end of the year. You talk about making it force you to get your numbers accurate, that gets your numbers accurate. So one thing I would encourage people to think about is, consider doing a state of the business address at the end of the year where you have to tell the story of your operation and where you're at and where you're going. And if you can do that, I think, the growth for more land and opportunities are going to be right there for you.
There you go, and have your whole farm team give all the standing ovations like the State of the Union. Grant, and then Ben, will have you get the final word. But Grant, we'll go to you next.
I would say mindset, very similar to what Evan had mentioned. And just based off of the introductory poll, I think we have a lot of individuals here on this roundtable that have the growth mindset. It's okay to be down on commodity prices or be a little bit concerned about the direction of land prices. But those individuals that say, you know what, I don't care, I'm still going to find a way to do it. They're the ones that typically tend to know their numbers the best. They're growing regularly. Opportunities find them, and they are active on a roundtable like this to learn about Fractal, to know what their options are, because they're going to find a way through hell or high water to grow when they need to grow. And that mindset just brings opportunities to them. And that's, I think, the best way to grow.
Awesome. And Ben, close us out.
Be prepared. Just echoing these guys. You might not be, hopefully you have a lender like Grant who's going to have these proactive conversations with you. Hopefully you have a coach or a peer group, folks like Evan and Chris that are doing that. Hopefully you know your numbers and you're using something like Profit Manager or some other analysis to get there. But then you just got to have those uncomfortable proactive conversations. And I know, that next thing that you're like, hey, I got to go get this field done, or that thing that's right in front of you is urgent. But it's not always, the most important if you think about what it could mean for your operation over 3 or 5 years. Hopefully we're a part of that. And if we're not, please tell me why, because we're always, we're pretty open to feedback on that. But go talk to other investors, look at other partners, be creative with your landlords, with local folks. It's about kind of building that path for that operation, not just this year, but over the next decade plus.
Great. And going forward, you should receive an email tomorrow with a recording of this webinar, so you can rewatch anything you want to rewatch. And we're going to be doing more of the webinar, so hope you'll continue to join us. Evan, Grant, Chris, Ben, thank you very much for the time this morning. Thank you to all of you in attendance, and we hope we see you on a future webinar. And be sure to get in touch with Fractal if it sounds like something that would fit your growth plans. We got to all the questions except for one, and it just says, thanks from Canada. All right, Casey. Thank you to everybody, and we will see you on the next webinar. Take care.